Hi, it's Sam Grieve here, Regional Manager for Flexi Grain in South Australia. Well, it's mid-May and many growers are still waiting for that elusive break. We have limited subsoil moisture and forecast for a late break, so production uncertainty is starting to build. One low-risk grain marketing strategy that growers may like to consider is Flexi Grain's hectare-based contracts. As the name suggests, growers are contracting paddocks, not tonnes, so it's mitigating washout risk. But just as importantly, it enables Flexi Grain to start managing price risk now, well before harvest. One of the key strategies that Flexi Grain use to manage price risk now is the use of put options. And I'd like to spend a few moments with you discussing how put options work. At the moment, global grain markets are very volatile, and this is presenting some great opportunities for Aussie growers to start marketing their 21-22 crop. Growers are seeing some very attractive prices for new crop, but it's only May, and many growers have not even started putting the crop in the ground yet, so there's still considerable production risk. The challenge for growers is balancing pricing tools against production risk. Growers can use tools like forward sales contracts, bank swaps, or futures hedges to capture pricing opportunities, but these tools do expose growers to considerable financial risk should crop production issues develop during the season. The use of put options is a low-risk strategy that growers can utilise to manage the risk of futures prices declining into the future. Flexi Grain like using put options because they have a known fixed cost and enable participation in any upward movement in futures markets. By using put options, growers are only risking the cost or the premium of the put option, and this is known when the put option is purchased. Another way of explaining put options is to consider them like an insurance policy that has a known fixed cost or premium and provides a financial benefit when a risk event occurs. In the case of wheat put options, growers are insuring against the risk of wheat futures declining. The holder of a put option has the right but not the obligation to sell a futures contract at a predetermined price or strike price within a predetermined period of time or expiry date. To demonstrate how a put option strategy works, I would now like to refer to a hypothetical example using the ASX's Eastern Australian wheat futures contract. Let's assume it's early May and the ASX Eastern Australian wheat futures contract for January 2022 has been rallying to a point that is deemed attractive enough to protect from any downward movement. On the 3rd of May, a put option is purchased for this contract with a strike price of $320 per tonne and for a cost or premium of $20 per tonne. Now let's fast forward to harvest time and let's assume that since buying the put, the ASX wheat futures market has fallen. On the 15th of December, Flexi Grain closed out their put option position by selling the option. The value of this futures contract has fallen to $240 per tonne, meaning the put option has a value of $80 per tonne, this being the difference between the strike price of the put option, which was $320 per tonne, and the current value of the futures contract being $240 per tonne. The net profit from purchasing the put option is $60 per tonne, being the value of the put option less its cost, which was $20. If the physical grain was then sold for say $235 per tonne, the final grain price result would be $295 per tonne by including a $60 profit from the put option. In this hypothetical example, the put option strategy has provided protection from a falling futures market. But what happens if the futures market rallies after purchasing the put option? In this situation, the put option loses value as it becomes unlikely to be in the money at maturity. Let's assume that the put option has no value on the 15th of December and expires worthless, as the January 2022 futures contract is trading at $380 per tonne. Flexi Grain then decides to physically sell the wheat for $375 per tonne. The final grain price result would be $355 per tonne after the cost of the put option, which is $20 per tonne. In this hypothetical example, the put option strategy has enabled Flexi Grain to participate in some of the futures market rally since the put option was purchased. I hope these examples have demonstrated to you why Flexi Grain regularly use put options to manage pre-harvest pricing opportunities for their hectare-based contracts. Compared to hedging, swaps or forward selling, put options are low risk, they have a known fixed cost, and they enable participation in any upward movement in futures markets. Thank you.